Well, welcome everybody. Steven Sitkowski here. Welcome to this week's edition of Market Insights. Happy to have you back. Hope you had a fantastic weekend. Let's see what's going on out there. Markets have been very well behaved as of late. I'm sure you've noticed. Quick reminder that everything that we do here is for educational and informational purposes only. It is not intended as investment advice. So, what to watch this week? A lot of Fed speak today, no real announcements. Ditto tomorrow. Wednesday, existing home sales, pretty light news until we get to Thursday. We've got initial jobless claims coming out. Last week, they were at 222,000. We're expecting 220,000 this week. We get our services and manufacturing PMI numbers. We'll see if the services and manufacturing section of the economies are expanding or contracting. A little more Fed speak. And then Friday, we get the consumer sentiment. As the consumer goes, so goes the economy. Last week's heat map got NVIDIA. We're going to be talking more about NVIDIA moving forward. It was up about 5%. Google, now Alphabet, 4.5%. Apple, Oracle, Microsoft, Palo Alto, all had really good weeks. JP Morgan, financials, just a whole lot of green. Our 1-year heat map looks like this. Look at NVIDIA at about 200%. Microsoft, 32%. Google / Alphabet, 45%. Meta, 91%. There's a ton of money to be made out there if you're a good stock picker. If not, it doesn't matter that the opportunity exists. Chances are you're going to miss it. So keeping score for the year, Dow's up 6.1%, S&P 11.2%, NASDAQ up 11.2%. So the S&P and the NASDAQ are just kind of moving in lockstep right now. Notice that bonds are down 1%. The future certainly looks bright. Earnings forecast supposed to be hitting record profits moving forward. Earnings are the mother's milk of the stock market. CPI has been pretty sticky. It came in at 0.3% last week. That was for the month of April, which is better than what was expected. It's supposed to come in at 0.4. Annual CPI is still at 3.4%. That is unchanged. So, it went from 9.1 down to 3, and it's just kind of moved in a relatively sideways pattern, which I know does not make the Fed happy, but they think their policies are sufficiently restrictive, and maybe they'll turn out to be that way. Economy is definitely beginning to slow. Economic surprises have been to the downside pretty much all this year, which is what the Fed is looking for. If you compare asset classes, year-to-date copper, well, this is the last 6 months, not quite year-to-date, up 31%, tech 30%, gold 20%, Russell 18%, S&P 17.5%, utilities 16.4%, the Dow's at 14%. Crude is at 8.7%, and then look at all the bonds. That's why I don't recommend bonds to people. If you want to put a little bit into short-term treasuries for safety, it's fine. Just know you're not making any money. All the money is being made up here on the equity side. Capital is definitely flowing into equities. Look at that, as it should be. Infrastructure expenditures are shooting up. Now, we can thank the government for that. It's not necessarily a bad thing, but the industrial portion of the stock market, pretty darn strong for that reason. We are in a risk-on environment. So the appetite for risk definitely moving up as optimism grows. Market sentiment right now is in the greed side. A week ago it was neutral, a month ago it was fear, now it's greed. Investors are just a fickle bunch. Whatever's going on at that moment is what we think's been going on forever and will go on forever. It's just not the way that it works. The VIX, so the VIX is known as the fear index. And the VIX is determined by looking at what traders are willing to pay to buy protection in the form of put options on their stock positions. And you can see the VIX is just way low. A lot of complacency. So that means that investors are likely not to be quick to sell stocks. And the latest Fed probability, so the next announcement comes up June the 12th, 96% chance that we stay. July 31st, 75% chance we stay. And right now, the bet is that we will get our first rate cut in September. Notice that's lower than it was last week. Last week, that was around 80, 85%. Now we're at 74%. And it is modeled in that there's 100% chance that we'll have a cut at the latest in November. This week's earnings, whole bunch. These are potential market movers. As we kind of scan through this, we got Target, TJX, so that'll tell us about the consumer. That's coming up on Wednesday. But the biggie, mark your calendar. After the market closes, we've got NVIDIA. That's going to be the one that will more than likely drive the tech sector based on their comments. I don't really see anything else in here that's going to by itself move the market. Let's take a look at the charts. See how they are shaping up. If we look at the SPX, that is the S&P 500. Looks great. Ever since we've crossed back above that 50-day moving average, we have moved on to new highs. The S&P is at 53.21, well above the 50-day. The slope on the 50-day moving average is higher. The MACD is strong. RSI is strong. Looks darn near ideal for today, subject to change. The Qs, same thing. And the Russell 2000 IWM, also in really good shape. Now, this is not at a new high. So there's where resistance is. So it'd be nice to see the Russell break through that. Generally, in election years, the Russell does really well because it's kind of a proxy for the economy. So appreciate you being with me. I will see you again next week. And until then, be safe and be blessed. Bye for now.